This is From the Courtroom to the Boardroom, the podcast for the next generation of legal leaders with me, Simon Gibson. I was a lawyer for 13 years until I walked away from legal practice and entered the world of business. I'm now CEO of the Spirent Group and I lead a portfolio of businesses in the UK and Australia. On this upbeat podcast, I tackle the big issues facing law firms and businesses alike with the help of intriguing guests. Are you ready to rewrite the script? Then it's great to have you along for the ride. Hello friends, welcome to the podcast. Cash is king. Well, if you're a law firm looking to grow your business, it certainly is. And my experience is it is not always easy to source the capital that you need to fuel your business plan. When I led a law firm, this was one of the areas I found most challenging because getting lenders to support your vision for your business could be difficult, particularly because they could be influenced by any volatility in the economic climate or the well-publicized failures in the legal sector that happen from time to time. So what are the do's and don'ts for law firms when they are looking to raise money? What is it that lenders want to see before they part with their hard-earned cash? And of course, how do the years ahead look, bearing in mind that we're told going into a period of economic instability all over the world? Well, I'm pleased to say we've got expert help on hand to guide us through those really interesting points in the form of Mark Farlow. Mark is a partner at FRP Advisory, who are corporate finance specialists, and Mark's based out of their London West End office. Over the years, Mark has developed a real specialism in helping law firms who are looking to acquire, sell, and raise capital for growth. I'm very pleased that Mark's joining us here today. So without further ado, let's get stuck into this latest episode of From the Courtroom to the Boardroom. This one is all about cash is king, raising capital as a law firm. Off we go. Mark, how are you, sir?
Hi, Simon. I'm very well. Good to speak to you, mate.
Yes, and you too. And let's get this on the table. First of all, not only do I know of your reputation, Mark, but I've got first-hand experience because you and your team led Spirent Group's successful capital raise in 2021. And I'm still very grateful to you for doing that because I must admit I was making something of a pig's ear of it before I met you. So I can recommend, first of all, you with absolute confidence. But first of all, Mark, tell us a little bit about your career so far.
Oh, goodness gracious. Okay, so I've been doing this for about 35 years, advising private companies generally across a range of sectors, mainly business services. But on that, I've come across a lot of law firms and other legal service advisors, and we've sold them, we've raised finance for them, and even made acquisitions. But the world's changed a lot since we started, and ABS has made life a lot easier. But there's certainly a lot of interest in investing in and lending to, even buying law firms these days. It's an exciting market.
I mean, it's interesting you should say that because, of course, every time we open the news, every time we listen to a politician, they would have us believe that we're entering into a period of unprecedented doom and gloom. But from what you're saying, Mark, it sounds like there's reasons for optimism if a professional services business, a law firm, actually wants to get involved in growing their business or selling their business. It sounds like there's causes for optimism there.
I think that's absolutely right. A good friend of mine taught me a new word 2 weeks ago, which is bifurcation. And when I looked it up in the dictionary, what it tells me is that for good opportunities, there's lots of money out there. And for the average or less well thought through opportunities, they'll struggle to raise money. But yeah, it wasn't a word I was familiar with. But the gist of it is there's so much money out there. Present a compelling opportunity in the right way, and that's our job to help you present it right. There is more money than ever out there, and that's debt as well as equity.
Well, let's start there, Mark, because I must agree with what you've just said about the business's story and their plan being presented in the right way. Because before I met you, I tried with no assistance or advice to raise substantial capital for about 3 or 4 years, and I was getting nowhere, I must admit. And the reason for it is it wasn't so much that Spire Group presented an unpalatable opportunity for lenders. It was that issue that I just wasn't presenting the numbers in the right way. I wasn't presenting the story in the right way. And I mean, presumably, because it's what you do for a living, you would support the idea that getting the right advisor at the outset was very important if somebody wants to, if a law firm wants to raise capital.
I think so. An experienced advisor knows what the market is looking to see, looks at the proposition through the funder's eyes. So it means that when they do open the document or sit down, it's something they're expecting to read, and it ticks their boxes, if you like. I think it's also we have a number of disciplines, things we need to see, things we need to explain that are obvious to us, but not necessarily obvious to the guy running a business. And maybe that's where you hadn't been clear on one or two areas. But we managed to raise money successfully for you. Lovely business. It was during COVID, though, so it wasn't the easiest at times, but we got there and we got it done, as you recall.
Well, you really did. I mean, that wasn't the only challenge, although it was a pretty significant one. I think one of the maybe one of the positives, but also maybe a slight negative with Spire Group, and I know with many groups, is that we have different service lines within the structure, and they do complement each other at a certain level. But it does need a lender who's prepared to look at things with that same element of diversity, rather than just look at like a one size fits all approach. Is that something you've come across in the past in terms of making sure that you find a lender who's going to be comfortable with that diversity in the portfolio?
I think most lenders are reasonably comfortable with some diversity, but it does lead to complications. Number one is it's important to be crystal clear what your market proposition is, what it is that you're trying to be, what you're trying to do. And when you've got 6 different divisions going in different directions, that's not always the easiest, particularly if you start off by saying we do 6 different things. So it's, we're about this is what we do, and there are a number of different facets to that, but that's what we do. It's the elevator pitch. It's not rocket science. It's going back to the beginning of selling any story. It's keeping it simple to start with and hooking the audience.
Well, this is where I was struggling, to be honest with you, because typical lawyer, I think I was approaching discussions with lenders on the basis that they would be as interested in the detail of my business to the same degree that I was. But I think what I learned pretty quickly is if you can't describe what it is you do and what you're trying to achieve in sort of 2 or 3 minutes, then it's probable that a lender's going to start losing patience. Is that right?
Lost patience, lost interest, yes. It's a story, it's catching their attention. It's not a disclosure letter at this stage. That's what it looked like to me at some times. Covering every piece of detail so as not to be caught out later. No, it's about storytelling.
That's right. And I mean, in terms of the elevator pitch, what is it? What is it that you're trying to get over to the investor in the short period of their interest that you have? Is the investor thinking at that point, is this a business which is secure? Is this a business I'm going to get my money back from if things go wrong? Or are some investors more interested in the really exciting stuff? How growth can be accelerated, how scale can be achieved. What's pushing and pulling the investor at that early stage?
Okay, I think there's 2 things there. One is, if it's a debt investor, they're more interested in certainty and security, and an equity investor needs to know the excitement and the growth. But there's 2 real things I'm selling or wanting us to sell to start with. One is the market proposition. What are we doing? Who are we doing it for? Why are we special? The second part is the growth plan. What are we going to do to grow value over a period of time? So that's what I want to sell. Because I'm then talking to investors and bankers, they're then thinking, oh, lawyers. Okay, so they've got a partnership. No. We then clarity about leadership, performance, and that we understand the quality of our earnings. So those are the hygiene factors. And we've all worked in partnerships, and that's not a business model that's ideal for investment. So we need to calm people down about that. Performance, yeah, we may be a law firm or a legal services firm, but we've got up-to-date management accounts. We budget, we measure against that, we check our KPIs. Quality of earnings is then understanding, this is maybe not quite such an obvious one, but it's understanding there's a difference between recurring, contracted possibly customers and income versus a business like mine, which is event driven. It's a company sale. So if you're looking at a law firm, an M&A lawyer is probably not the securest form of income. So those are the issues we try and calm the investor down around at an early stage. And there's one reason why we do that. It's funny, you talk about recession, there is lots of money. What there isn't any more of is time. So investors are generous with their money, but very mean with their time. So unless you hook them early to say, this sounds interesting, and it sounds like they know what they're doing, they're not going to invest their time in your opportunity. And what we're asking for is, please spend some time with us so you can understand what a great opportunity this is. And that's the theme of the market at the minute, spending that time.
And that goes back to your point, isn't it, about having your elevator pitch, your story in as succinct a fashion as you possibly could. But it was interesting because what you've moved on to there is a bit more of the detail if you are able to hook the investor's attention. When you've gone through there, the issue around quality of earnings, growth, leadership, which I want us to pick through. But I was fascinated by what you've just said about the partnership model, because when I was in a partnership, one of the problems you had from the get-go was that what tends to happen within professional partnerships is you have a group of people who are all of different ages. And because the partnership is quite a clunky, a clunky vehicle to lead in terms of decision-making, then the various financial aspirations of the different partners can really get in the way of decisions being made, either about the fundraise itself, or when you get down to brass tacks with an investor, if they think that you're going to have to go through 5 layers of bureaucracy to get a decision on anything, that can be a massive turn-off. Is that your experience of how investors view old school style partnerships in the legal sector?
Absolutely. Absolutely. And I speak as someone that's worked in 2 big accounting partnerships over the years. The number one turn-off for an investor that will stop them looking very early on is we have to put decisions to a vote. Anything that puts things back to the partnership. So unless you've got devolved authority to a leadership group or a CEO, as we had at KPMG and Grant Thornton before that, unless you have that devolved authority, it's going to make life very difficult for all but the most basic of debt lending. I don't think it crosses out the debt lending, but certainly in terms of equity investment and significant growth, it makes life difficult, I think.
Yeah, I think there's a really point here for anyone listening and watching who perhaps doesn't have that devolved authority within their organisation. You really do need it, and I'm talking about a wider issue here than just raising capital. Effectively, if you're leading a business and you have not got that devolved authority to make decisions on behalf of the business, then leadership becomes impossible. And indeed, I wouldn't be prepared to lead a business or a group where I couldn't make decisions within a pre-agreed mandate. And again, we're back to this issue of partners. I mean, remember when I was in a partnership in a law firm, sometimes you needed 4 partnership meetings to decide what colour you were painting reception. And that's not a recipe for entrepreneurship. And I mean, it must be even more of an eyes rolling moment for an investor.
Absolutely is. And if you think most investors that we're talking about in this environment are private equity, they're not public equity, and private equity is all about quick decisions and getting on with things. Whereas if you do anything you recommend or want to do with a public company, it has to go to a shareholder vote. That's much more like a partnership. And if you can't convince everybody, so it's just anathema to the private equity investors in particular. I think debt funds and banks for lending, it's slightly easier to cope with the partnership model, but never equity.
Podcast today is brought to you by Zeus Tech Solutions, who provide dev on demand for law firms. When I was managing partner of a law firm, recruiting and retaining top tech talent was one of the biggest challenges. And worse still, because we didn't have the knowledge in the business to manage and coach a technical team, it was a constant cycle of frustration, downtime, lost revenue, and proclaim lying dormant. Well, for the past 5 years, Zeus have looked after both of Spire and Group's law firms in the UK and Australia, and it's been a game changer. Now we get all of our tech on tap, from IT director to .NET developer. We get that whenever we want. Zeus provide the best use of tech to all of our fee earners with no recruitment fees and absolutely no nonsense. So if you're a law firm who are frustrated with their tech anywhere in the world, go to www.zeustechsolutions.co.uk and hit the live chat option, and the answer to all of your tech solutions, however specific they are, is right there. Better still, if you mention that you heard about Zeus on the podcast, you will get a free health check for your case management system. So that's Zeus Tech Solutions, dev on demand for law firms, and now on with the podcast. Let's just drill into some of the terminology we're using here. I'm sure the vast majority of people watching and listening will know what private equity is. But just summarize for us what a private equity investment is and how it differs from a debt investment, which typically would come from a bank or the like.
Okay, so private equity, it's a management company who's raised hundreds of millions in a fund from pension funds and the like to invest typically in 10 to 20 companies in a fund. Normally they're generalist investors, so they're not all investing in law firms or accountancy firms or marketing firms. They want one of each in their fund. And they are investing to put money in to get a return of their target 2.75 to 3 times their money back, so that across the fund they're making at least 2 times and hopefully 3. And they're not looking for their money back normally every year or every month. It's on exit, their return on exit. So they want to know they're going to buy here and work with you to grow the business to sell it here for a nice gain. There are subtleties about how they structure that. It typically invests most of its money by way of loan notes, which have a coupon that rolls up, and then into the equity. So they're hedging their bets by protecting their downside by investing in loan notes, plus taking the return on the upside. And that's interesting and important when you come and look at debt funds, which are funds raised in a similar manner, which want to lend money typically at similar rates of interest, maybe 8 to 10% interest, but either don't want an equity return or just want a tiny equity return. And the structure of those investments, much cheaper than a debt fund than a private equity fund, can look remarkably similar in the downside protection area.
And so let's say you've got a law firm coming to you, Mark, and you think they've got a decent elevator pitch, the story is clear. How would you make a decision on which part of the market to approach? What does a private equity opportunity look like? And how's it different to just one you would take to a bank or another debt funder?
So I think for private equity and debt funds, you're looking for significant growth. Okay. So the business needs to look bigger, more profitable, and more valuable in 4 or 5 years' time out. Typically, we would have always gone to private equity for that money in the old days. What we've had in the last 6-7 years is debt funds coming in. So if you only want to raise, should we say, 3 times EBITDA rather than 5 times EBITDA, you might be able to do it proportionately cheaper with a debt fund than with an equity fund. And that's really the difference. So growth capital we used to do with private equity, we're now looking at debt funds as an option. If you're looking to do a buyout of the whole business or sell the whole business, then that's private equity. That's not really debt funds. Does that make sense?
It does. It certainly does make sense. Let's just get some of those figures right. You mentioned earlier that with debt, so if I'm raising £5 million and you manage to get me a debt investor, did you say you'd be looking at a return of sort of 8-9% of capital raised?
So if we're looking at £5 million, the first thing we're looking for is, can we borrow it from a bank on a secured basis, secured on your debtors, secured on property? Those interest rates are much lower. If you're 4%, 5%. If you're going to a debt fund, it's more expensive, but it's cheaper than private equity comparator because you're not giving away so much equity. So we don't think of debt funds as a replacement for bank debt. We think of debt funds as a replacement for more expensive private equity.
I've got you. And you talked us through earlier what the cost was. I mean, I've never taken private equity capital, but if the private equity investor is looking to invest 5 million, and then you said sort of 2 or 3 multiples of that would be their return, so they'd be looking to take 50 million out of the business when their exit happens. Does that mean in practice that the business would effectively, in the early part of their growth journey, they'd be working effectively to generate the revenue to provide the private equity investor with their exit?
They're looking to grow the whole business for everybody's exit, everybody's capital value, but the private equity house wants to make sure going in that the growth that management can bring to the party is enough to satisfy the private equity requirements as well as management's. But in a way, that's why it's much more suitable, private equity, for management buyouts, buying a whole business, a whole legal services business, whether it be the Murgatroyd deal we did, Lawyers on Demand, those sorts of companies that have on a significant growth trajectory. I would have said on a mature, steady law firm, it's difficult to find those returns when you're at scale, whereas your business was small but perfectly formed and growing like that. So was easier to access slightly more expensive money when the bank said, oh, this looks too difficult for us. That's why we talk to debt funds.
Totally. I mean, but let's just touch on banks. I'm not being slanderous towards any particular bank here. However, in the years I've had in working alongside them, I'm just not sure that business banking is fit for purpose in terms of anything other than a very slow and steady, stable business. I'm not sure that banks really, not only will they fund growth, I'm not sure they can, just because of the risk profile that seems to have developed and the relatively tight margins at which they operate. Do you have much joy with banks?
I think that's fair. We do work with banks, and we do find them supportive for the right opportunity, but they are more cautious. And as much as anything, they're more cautious to lend. But having lent, banks make their money on the margin on the fees when they lend, rather than the margin going forward. So banks will lend you money, but what they want is it back as quickly as possible. We call that velocity of capital. Banks typically want their money back in 3 to 4 years, unless you're doing invoice discounting. So let's just park that. A debt fund will lend you slightly more money, and it'll say, once we've decided you're a good credit risk, we really don't want you to pay it back in a hurry. We're lending it to you because we want to make that margin on the interest. So please carry on borrowing it from us as long as you want. And we put a 6 or 7 year bullet repayment in the documentation. The expectation is there'll be another corporate event, a sale, a refi before then. So having found a good customer to lend to, they want to keep lending and earn their money through the interest. Whereas banks, remember, earning their money through fees on the original deal, then they just want the money back as quickly as possible.
Yeah, I've got you. I mean, that makes total sense, doesn't it? Because if an investor has got that capital to deploy and they find a business which can reliably and securely deliver them a return on that investment, well, that's clearly a much better bet than putting it in the bank themselves.
Exactly. And they've raised that money for people who want to find a home for that money. Whereas corporate lending to SMEs, for banks is a very small part of their business. For high street banks, that's not really what they're here for.
No. The other point, one of the other points you mentioned earlier, which really struck a chord with me, Mark, you mentioned this issue of leadership and how that's sort of on the initial agenda in terms of what an investor might be looking for. And this was one of the things which used to frustrate me with bank lending, insofar as the relationship you had with the person, with the manager who looked after you, was really just the first port of call in the banking machine. And if any decisions had to be made around the likes of facilities being renewed, you ended up getting kicked up the chain to a credit department who you didn't know, and really was just like a computer said no type scenario. But when we worked together and when you introduced us to a number of different investors, I really did see that those type of investors, they did actually care about who it was who was leading the business. They wanted to understand the cut of your jib. They wanted to satisfy yourself that you were in the detail, that you were a strong leader, that you did have that devolved decision-making. So is that what you find, that the stronger the leader, the clearer the mandate that the leader has got, the easier they are to present to interested investors?
Absolutely, and that's one of the first judgments we take before taking any client on. There used to be a saying back in the day, there are 4 important things in a management buyout: management, 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 management. And that's still true. So we can have the best business in the world, but if our management don't inspire, then it's a difficult fundraise or difficult sale. I suspect that maybe the debt funds and the private equity guys are also better at defending the fact that they're still not the decision maker, because they've all got credit committees above them, same as the bank has. It's just they don't hide behind it. They try and pretend that they're making the decisions when all the same. They've still got to write a credit paper and send it up to credit committee for Monday. It's still the same. But I think the difference is about being prepared to help them fire the bullets.
Well, that's the point. That was what I certainly saw, that the distance between the representatives of the investor who you were talking to and the credit committee, that seemed a lot closer to me and a lot less robotic than it was with sort of retail banking or business banking. So just on that point of leadership, how do we define, when you get someone who walks through the door and says to you, Mark, I need to raise 5 million, I'm the CEO or I'm the managing director, how do we define a good leader? Or is it more down to your instinct?
Well, number one is it's just one of those things you can tell, Now, when I asked you when we met, I asked you to tell me about the business, and you could verbalize it, and you were aware of the risks and the opportunities, and I got a sense from that you seemed like a good manager. Now, I didn't know whether you were brutal with your staff or lovely and brought them cream cakes on a Friday. I couldn't tell whether you were a good manager. I could tell about the perception to the investor. And I knew I could sell you, but I'm after 20 minutes.
Well, thank you very much for that. I definitely don't bring cream cakes in. Certainly not since COVID.
Well, apparently it's close to workplace harassment now, bringing in cakes to the office, I hear.
Yeah, that's the one. But yeah, that must be interesting for you to make a judgment call on, because of course, in this world where, as you've rightly said, time is short, as are attention spans in terms of investors. If you put, particularly in the legal sector, where still lots of law firms are led by not just lawyers, because obviously there's nothing wrong with that. I'm a lawyer myself and really proud to be, but by lawyers who are actually still fee earning. So the managing partner at some law firms will have a caseload, will have a client portfolio. And it's so difficult for someone who has those technical legal responsibilities to detach themselves from the detail and to project with positivity this issue of the elevator pitch and themselves as leader. Is that what you found?
I think that's fair. I'm trying to think if I've actually come across a leader in the legal services space or law firms in the last 10 years who's actually still on the cases, if you like, or still up to his elbows or her elbows in caseload. And I think we're seeing a lot more detached CEOs. I haven't seen someone that I thought, goodness, that would be a great business if only that CEO, she wasn't still running cases 4 days a week. I think those days have probably gone amongst the clientele that we meet and we see in the sector.
That's interesting, isn't it? Because, I mean, there could be a number of reasons for that, couldn't it? I mean, obviously, in that last 10-year period that you've referred to, that's when non-legal ownership of law firms has become permissible through the alternative business structure rules, which has brought, of course, much more entrepreneur. Well, I say this, it's certainly brought different perspectives into the sector in terms of non-legal leaders, also, as you say, investors in law firms from the private equity world. So I guess that could be something which is the driver behind that. One of the other points you made before, Mark, which I just wanted to drill down on, was this issue of quality of earnings. And it seems to me that this is one of the big problems that law firms have. And we can find ourselves stuck between a rock and a hard place because, on the one hand, as you've said, the event-driven law firms, the likes of M&A corporate practices, perhaps even on the consumer side, the likes of family law practices, maybe crime practices, the event-driven, the sort of crisis purchases, so to speak, they usually don't have a big bank of work in progress and probably not any long-term contracts. But I think on the other side of that, law firms who do have, for example, a large work in progress bank, they've been the cause, it seems to me, of one or two of the more spectacular failures in the sector in the last 10 years, when sometimes the work in progress isn't worth as much as was hoped on deal date. Is that something that you've seen? And are investors quite canny now in the way they interrogate work in progress?
Oh, absolutely. But if you think the first private equity deals I got involved with in the law sector were in the claims management space. And what you could see, there was good visibility of cases, good work in progress, a steady pipeline, and consistent accident rates. So that was all fine. What you then had was a regulator from left field coming and changing the goalposts every 3 or 4 years. So the challenges in that sector were not internally generated, very much externally from a regulator. Very much in parallel to the law firms, you've got the accountancy firms being gobbled up by investors at the minute. And there is a huge disparity between the attractiveness of an audit and tax business, where the clients come back every year without fail, pretty much, versus somebody in M&A like ourselves, who are absolutely event-driven. So I think the parallel is there in a slightly different sort of professional services. But yes, cash conversion, when you've got huge WIP balances, is absolutely essential to monitor, manage, and make sure you're not buying a kipper.
Yeah, or you don't want to buy one of them. The other thing, obviously, a big part of the way investors will undertake that interrogation, I think technology's come into the equation a lot more than perhaps in previous years, insofar as the quality of the management information that law firms are able to present to investors and how much that is backed up by good quality data, which typically would be extracted from their case management system. I think that can help an investor ever so much in terms of really getting comfortable, not just with what the numbers say, but with the credibility of the business that they have in front of them. I would say to any law firm that before you hit the capital trail, make sure that your technology and the data that is being stripped from it stands up to scrutiny. Have you ever had any circumstances before when the data or the technology that drives it has been what's let a client down?
Yes. touch wood, it's one of the things when we start to engage with the client, we get to look at fairly quickly. Because there's no point us putting 3 or 4 months of hard work in to find that diligence turns up that the underlying data is flawed and not reliable, and we fall over in diligence. So we'll go and check that very early on. It's probably the second thing we check after. Do we believe the management story? Do we believe the management's credible? But no, absolutely, it's hard to imagine if you went back to days of manual or semi-manual whip schedules and all that business. These days, you've got to have the data because it's got to be interrogated quickly and compared over time. It's not just what's the data say at this month end or that month end. It's how has that trended over time. So the data books and the data inquiries early on are absolutely essential to make sure, as you say, everything stands up as it should.
Yeah, absolutely. And it always amazes me that this isn't just a law firm point. Businesses are so reluctant to invest in the technology at times, and that can have an impact upon these really exciting periods when they're looking to grow and they're looking to persuade others to become stakeholders in some form, and an investor would be that. So I mean, what I would say to any law firm, if there's one area you should not neglect, it's your tech, because increasingly any stakeholder who you are inviting to participate in your business in any form will have a great deal of interest in your technology, in terms of how your people use it, and in terms of the quality of management information that's stripped from that. So my message to everyone, this particularly if they're thinking about raising capital or acquiring or indeed selling, is don't scrimp and save on your tech or the quality of the people who operate it.
Totally agree. Couldn't put it better. It will undermine any value you get out later if you don't do it right and invest properly. Totally right.
Lovely. Well, unfortunately, we're coming somewhere near the end of our chat, Mark, and it's been wonderful talking to you. Let's just try and pull this all together for a law firm or any other professional business who might be interested in going on the acquisition trail or perhaps selling or raising capital for growth. I mean, you're a really renowned deal maker in this space, and I know you're consulted frequently by professional services businesses in this area. If someone comes to you with the right elevator pitch but nothing else, what would be the shopping list you sent them away with before you could really roll your sleeves up and hit the markets?
So I come back to my 5 tenets every time, which is market proposition, growth plan, leadership, demonstrate that to me, performance, and tell me about your quality of earnings. And if you can present that to me, then I'm ready to roll my sleeves up and get involved and help. And someone that comes to you without one of those 5 is going to struggle. Maybe sometimes we send them back to go and rethink your growth plan and explain to me how we know we can make this more valuable over the next 3 or 4 years. But those are my 5 tenets. If they work, we're ready to get stuck in.
And I can talk about this through personal experience, of course, but it was a game changer for me and for Spire Group, having an advisor working alongside us to basically, as much as anything else, it's not just about what you should prioritize in terms of the way you present your business, but it's what you shouldn't. And to have an expert who can guide you through all of those various pitfalls and challenges is worth its weight in gold. So I know that you're a real specialist in this field. We've got all of your links and contact points in the foot to the podcast. Wherever you've got it, ladies and gents, wherever you're getting your podcast from, Mark's details will be in the description. And I know you really enjoy doing deals in this space.
Absolutely. For us, it's all about working with good people with a passion and an idea and helping them deliver that. So it's great fun. But equally, you wouldn't climb the Himalayas or go into the Amazon jungle without a guide. I wouldn't go into the financial markets without a proper experienced guide either.
Well, what a great point to end, and I could not agree with you more, Mark. So thank you again for your company today. It's been so valuable. Thanks everyone for watching and listening, and we'll see you on the podcast next time.